After the crash of 2008, a lot of banks use a device called a loan modification to help homeowners save their homes. Now, a loan modification has mixed results. A lot of people were able to save their homes through loan modifications, but a lot of people lost theirs. But a lot of people still lost their homes because they didn't know how to apply, and at the time, a lot of banks didn't really know how to process them. Well, loan modifications are back after COVID, and a lot of these banks have a lot of experience at this point on how to process loan modifications, and loan modifications have evolved from a very arduous process to, in many cases, a simple process that's out of the control of the homeowner. Now, that's good and bad. A lot of times homeowners now can qualify for loan modifications that they couldn't qualify before. However, that also shuts out a lot of people who could possibly qualify for loan modifications who now do not qualify for different reasons. In this episode of Debt Law, Survival Guide for the Desperate Debtor, I'm going to be talking about something called a Flex Modification. Flex modifications exist for Fannie Mae and Freddie Mac homeowners, which are basically the majority of the homeowners in the United States between those two groups. I'm dividing this topic up into two pieces. Now, in the first part, we're going to be talking about something called the MTMLTV, which is the mark-to-market loan-to-value. Now, this is the secret formula on how the banks determine if they're going to offer you a loan modification. Now, I'm going to give you a little bit of a hint. This is a very complicated formula, but I'm going to try to explain to you in a way that you can understand so that when the banks offer you something, you know what you're getting. Now, we're going to be talking about a no document flex modification. This is something sometimes referred to as a streamline modification. Now, what happens basically, and in this episode, I'm going to be focused on people who are 90 days or more late. That's the thing. If you're less than 90 days, a lot of the stuff I'm going to be talking about in this episode does not apply. But you should watch it anyway because a lot of the concepts do apply. And if you continue to be late, you're going to be talking about a streamline modification later on. So stick around. I'm going to tell you what happens when the bank is looking at you for a streamline flex modification, and what happens when you get that envelope and you get all excited and then you open it up and you sometimes are shocked because the payment actually went up. A flex modification and a streamline modification is something that the federal government came up with to deal with people who are 90 days or more late. There are options for people who are less than 90 days, and again, I'm going to be talking about options for those folks in the next episode that I'm going to be shooting after this one. Now, in this episode, however, this is for people who are more than 90 days late on their mortgage. Now, a streamline modification is something that just shows up in your mail one day when you've been late for a while, and they just offer you something. Sometimes you can afford, sometimes you can't afford it, but you just get this thing. You didn't apply for anything, it just shows up in the mail, and all of a sudden you're looking at something that sometimes helps you and sometimes hurts you. But I'm going to explain to you why you might still want to take it, even if you really can't afford it. I'm going to go through the different options. I'm going to go through people who are underwater, people who have a equity of between 0 and 20%, and people who have equity over 20%. And I'm going to tell you that people who have equity over 20% are the worst off when we're talking about loan modifications. So let's get to it. The first thing you have to understand are some of the concepts and some of the things that you're gonna hear about when they're talking to you about loan modifications. First thing is something called the unpaid principal balance. Now, the unpaid principal balance is basically a fancy term for everything you owe the bank. That's all the late fees, all the late interest, all the unpaid principal, all of the escrow that you haven't paid, everything. Now, the best way to get this number, and you need to get this number if you want to try to do this calculation at home so you can figure out if they're going to offer you a streamlined loan modification. The best way to get this number is to ask for a payoff. The payoff basically is an amount of money that the bank will accept to pay off your entire mortgage. This includes all the arrearage, which is the late fees and late payments you haven't made, all the escrow advances, which is all the escrow you haven't paid, and anything else that the bank is charging you. This document takes usually a few weeks to get, sometimes faster, but you should request it. Sometimes you can get a number over the phone, but don't go with that number because that number is not exact. Now, the next thing you could look at if you don't want to wait is you can look at your bill, and you're going to see a number there, which is all the late payments and what you still owe them. Now you can add those two numbers together and you're going to get a number. Now that is not the unpaid principal balance, because there's other fees and things that the bank's going to tack on, but that will give you an idea of what you actually owe. So if you're really desperate to know your number, look at that, look at your statement, and you can come up with a number that's close to probably what you owe. The last thing you don't want to do is guess. Don't use your memory, because guessing or thinking, well, this is wrong, or coming up with some crazy number is not going to get you anywhere. You're just wasting your time. So the next thing we need to determine what the Streamline modification would look like is the value. The property value is something that's determined by the bank. Now, they don't go to your home and do what you would normally would have as an appraisal. They don't come to your house, they don't look inside, they don't see the beautiful new pool you put in, or the new cabinets, or the stuff that you added, none of that stuff. This is something called an AVM. That's basically a computer-generated model of what they think your house is worth. Now, they can also use what's called a broker price opinion, a BPO, and some other stuff, but you can't get a hold of any of this stuff until you actually apply. So you're not going to get this number. Now, if you do get a Streamline in the mail, you can always ask and say what was the property value that you used. If that's the case, then you can counter it with an appraisal of your own or whatever. But we're not talking about that right now. What we're talking about is using your own numbers and coming up with what you think might be the Streamline offer that you're going to get. So you're going to look at Zillow, Realtor.com, or Redfin.com. Those also use AVM computer models, and those models are sometimes pretty close to what the bank uses. I would average the three. Those are the big ones. Average the three. I'm sure there's other ones. It doesn't matter if you want to look at something else, or if you're a real estate professional, you might be able to do your own BPO. But don't rely too much on that. You can use this, and that will give you a good idea as to how much they think your house is worth. Now, the next thing that they're going to look at and what they're going to do with those two numbers is something that you can do at home to determine a very important ratio, which is what we talked about at the very beginning, which is the MTM loan to value, LTV, mark to market loan to value. Before we get there, you still need a little bit of information. You need to come up with your principal and interest payment. The easiest way to do this is to look at your bill. There's 4 things that are paid in the bill, or sometimes more, but generally principal, interest, and your escrow, which could be divided into your taxes and insurance, or it could just be one line, which is the escrow. All you need is the principal and interest payment, because that is what the bank's going to use to determine a lot of things when they're looking at loan modification. So go to your bill, get the principal and interest payment, add those two numbers up. In my example here, I have $1,100. So this person's paying $1,100 for principal and interest. The next thing you need to know is your contractual interest rate. And yes, there are still some ARMs, which are adjustable rates, but we're not talking about those right now. It gets too complicated. Most rates are fixed right now. So you need to get your interest rate. You can get that from your original note, or you can call the bank and ask them, what is my interest rate? And they'll tell you. So you need to write that number down. The last thing you need to get is the Fannie Mae modification interest rate. You can Google that. Now, I did that this morning, and the most recent one is 2.85. Now, that means that the Fannie and the Flex modification, they can go down to that interest rate to give you a new interest rate when they're trying to modify your loan. So, now, this is really important information, especially the current, your current contractual interest rate and this lower one, which is the Fannie Mae. Depending on where you are with the loan to value to property, loan to value ratio is what interest rate they give you. I'm going to explain to you how they actually determine this ratio right now. It's pretty simple, but you got to look at it, and I look at it all the time, I understand it, but a lot of people who don't have to actually see this in writing. So what they do is they take the unpaid principal balance, which is everything you owe, and they divide it by the property value. Trust me, this is the formula. There's no other formula. It's not the other way around. You take the unpaid principal balance, you press the divide sign on your calculator, and then you enter the property value that you determine by looking at Zillow and the different websites, and that is your percentage. That percent, and then if you're not really sure how to do it, you just basically move the decimal point over 2 spaces, and that will be your percentage. In my example here, we have a situation where the property owner in this situation is underwater. Now what that means is this property owner owes a lot more on the mortgage than the property is worth, which is the case for a lot of people. Now in this situation, the owner owes $400,000, which is the unpaid principal balance you see here. The value I put as $300,000, which, you know, this is a hypothetical, so we're using whatever value I want. And you get 133% loan to value. Now, in this particular case, and only in this case where the property value is underwater, the bank will defer up to 30% of the unpaid principal balance. 30% of the unpaid principal balance is $120,000. So what the bank does in this situation is 2 things, or 3 things. First, it defers $120,000. So you're only paying interest on $280,000. They extend that to 40 years, 480 months, and they give you the lower interest rate, the Fannie Mae interest rate of 2.85%. Now, what that does in this situation is these folks here will get a new mortgage with a reduced payment from $1,100 to $1,048. So they're gonna get a lower interest rate. They're gonna get a lower payment by about $50 a month. Now, this principal and interest payment is obviously you have to add the escrow and the taxes, but you have to remember something, what's going on here. These folks have been late for more than 90 days. So this isn't, you say, oh, well, they only got a $50 reduction. Yeah, but they owe a lot of money. Who knows how many years these folks have been in default. They took all that money that was owed and they put it into a new mortgage that now these folks can afford because it's $50 less than they were paying before. That's the value of the loan modification in these situations, because now the property owner can afford this new mortgage and they are able to get back on track in paying their mortgage. Yes, the property value, the property is still underwater because that $120,000 is actually a balloon payment at the end in 40 years, but who knows what's going to happen in 40 years. We had no idea it was going to be a pandemic, and a couple years ago, and look what's happened. So we have no idea what's going to happen in 40 years. So you might as well take it, make your mortgage payment, and move on. Now, the next situation that we're going to look at is a situation where when they did the UPV to property value ratio, it came out to 83%. Now, what that means is that you only have 17% equity. You need more than 20% equity for certain things to happen, which aren't very good, but in this situation, it's actually helpful that you have less equity. When you only have 17% or less than 20%, the bank will give you a new modified payment. Remember, this is the same exact situation as the underwater folks. These folks have not paid for a long time, but they still maintain a little bit of equity. Why? Because the property values have gone up and maybe something changed in their lives. They were making good payments before, then all of a sudden they had to stop for whatever reason. There's a sickness, who knows, and now they had to stop for a little bit, but they still have a little bit of equity. In this situation, the payment actually goes up a little bit to about $1,300. It went from $1,100 to a little over $1,300. However, this is a new mortgage. So these folks, yes, it's a little bit more than they were paying before, but maybe they can afford it. And maybe they can take this payment and afford this new payment and save a little bit of that equity and keep paying it off. There's no deferment in this situation. There might be a 3% deferment because they try to get to 20%, but we're not going to get into that. Let's assume there's no deferment. They keep their 17% equity and they get to make their payments and live in their home. This is a very good situation for these folks. I'm sure they would accept this loan modification. Now, the last group, and the ones that, excuse my French, basically get screwed in these situations. These are the folks that have more than 20% equity. In this situation, I put a value of $510,000 with a $400,000 UPV. Now, in this situation, these folks have 22% equity. Now, the bank will then take that 22% and, will take the unpaid principal balance, they'll extend it out to 40 years. However, they won't give you the lower Fannie Mae modification interest rate. They'll only give you the contractual interest rate. So you get the extension of term, but you don't get the lower interest rate. The effect of this is that you actually get a much higher payment, around $1,700. Now, before you freak out and before you say, oh, well, how can they do this? There's a couple things going on here that you need to understand. Number one, a homeowner that has more than 20% equity can probably refinance their home. Now, the problem is a lot of people in these situations have defaulted, therefore their credit's bad. But the bank doesn't care about that. What they're saying is, well, these folks, if they can't modify, then they can refinance. Now, that's one thing that you need to look at. These folks might be able to refinance. This 2% extra is probably not enough, but let's assume that maybe it's a little bit more. Maybe they have 25% equity and they can take their loan and go refinance and then pay off this first mortgage and then move on with their lives. Maybe at that point get a lower interest rate. But as things stand here, the only thing that the bank's going to offer them is a higher payment. This happens often with with these streamlined loan modifications. Folks get a higher payment. Now, I'm going to tell you something about this. For these folks that this happens to, that when you get the higher payment and you freak out, if you're like that last example, you have a lot of equity, you have 20% or more equity, you still might want to take the loan modification, because after 3 months of making that higher payment, they will rehabilitate the loan with a final loan modification. That will basically end all foreclosures, all the different options that they have against the property to take the property. They'll stop all that. They'll dismiss the foreclosure case. They will put your on your credit report, say that you're current and every payment you make is a good payment. That will help you rebuild your credit. A lot of folks can rehabilitate their mortgage in that situation, make the sacrifice of making the higher payment for a few months, and then maybe after some time of making the higher payment, they can refinance. They can take advantage of the lower interest rates that exist now. Maybe there is a difference in interest rate, and they're able to get the lower interest rate, but they have to rehabilitate the loan. That's the value of the Streamline modifications. These streamlines are set up so that you can rehabilitate the loan. A lot of folks can benefit from this if you look at it like that. If you focus only on the payment and you say, well, loan modification is supposed to lower the payment, it doesn't always lower the payment. With these streamline modifications, a lot of times the payment is higher, and I'm explaining the reasons why. Now, you can still take this and you can still use it to your advantage. What have I explained to you right here is basically, if you're more than 90 days late, you can take the unpaid principal balance, you can divide the property value, like I showed you, and then you can kind of determine where you are on the rankings. You can, if it's more than 20% equity, you have to use your current contractual interest rate at 480 months, at 40 years. If you're between 0 and 20%, you get the lower of Fannie Mae or the contractual interest rate, which is usually the Fannie Mae rate, which you can Google and find out right now. And if you have no equity, you're the best of all the three, and you can basically get the 40 years at the lower interest rate. Now, again, this only applies to people more than 90 days. There's a lot of people in forbearance right now who are looking to get a loan modification. My next episode is going to focus on this group, which are people that are current. This group of people, and if you noticed, I didn't talk about expenses of income during this entire episode, because That only comes into play for flex modifications when you're current or less than 90 days. When you're current or less than 90 days, they do look at your income and they do look at your expenses. So if you want the best deal for loan modification, you need to apply during the first 90 days after you're in forbearance or you come right out of forbearance and you're unable to pay. You need to make that application right then and there before 90 days lapse. Because after 90 days, the options become very limited. They start talking about these flex modifications, which sometimes work, sometimes they don't. Depending on, you saw that, it's a complicated loan to value proposition that sometimes works out really well, but sometimes it doesn't. So I've seen things all over the place with these streamlines. Sometimes they're beautiful and people love them. Sometimes the people freak out and say, I cannot pay this, and forget it. Now, that's your choice. That's what's going on with these flex. So that's it for now. Please subscribe and like these videos so I keep making them. Again, the second part of this, which I'm going to release on Thursday, is going to talk about people who are less than 90 days. So those are people in forbearance. So if you like what I talked about in this one, please stick around for my next episode because I'm going to focus on that. And I promise people that I'm going to do videos on the USDA and the VA, which those are coming in the next couple weeks. I'm still researching those, which are a little bit more complicated than these other ones. But for now, please watch my channel, Debt Law Survival Guide for the Desperate Debtor. Like my videos and subscribe, and I'll keep making them. My name is Diego Mendez. I'm a loan modification and bankruptcy lawyer here in Miami, Florida. I've been doing this for many, many years. I've helped a lot of people with loan modifications, and I've assisted in helping people save their homes throughout the years. Thank you very much, and have a great week.